First of all, thank you for having me. We've thought about this a lot over the years about what constitutes an emerging markets country for the purposes of investing in debt. And I like to think of it as, are they borrowers from developed markets? And often in the cases of the high income GCC countries, the Saudis, the Kuwaits, the Qatars, and so forth, they not only lend to other emerging markets economies, but they even lend through SoftBank and other places to developed markets economies.
Right.
So for me, if you don't borrow from EM investors, you're not EM.
Oh,
So this is also true of China, by the way.
well, I mean, Tina, first of all, thank you so much for joining us. I mean, we know that, multilateral finance institutions like the World Bank and the IMF, they have their own definitions. I mean, index providers like Bloomberg, right? MSCI, JP Morgan have other definitions. And so I guess, for me, the question is, you have referred to emerging markets, specifically local debt, as this rare once in a lifetime opportunity. Has that narrative changed at all in your view following the war in Iran?
It's a good question. So, when we make these kinds of assessments, what we're trying to do, I think, like everybody else, is to compare the price of something to its fundamentals. So, whether it's hard currency debt or local currency debt, you're looking at the fundamentals of the economies involved in broad strokes, again, using the benchmarks to take a first stab at it and say, how is the price of these instruments, the currency, the interest rate market, relative to the fundamentals that drive these things? And when we say it's a once in a generation opportunity, I don't think I'm original in observing that the dollar is quite rich. I'm actually in Brazil right now, where you go out to dinner, it feels like it's free. So, the valuation case is there. So then you have to ask yourself, are the events of the last week, and I'm
Right.
literally just coming back from vacation today, so blink and you missed it, I guess. Are the events of the last week going to change the fundamental inputs such that when you compare prices to fundamentals, again, you come up with a different case? And I would say at this juncture, not really. I mean, in aggregate, we were just looking at the
Well,
betas last night of our portfolios to oil, and there's not really a beta there. So in aggregate, this doesn't matter yet. I think it will have more of an impact if it impacts growth globally.
Tina, most of America was not on board EM like Damien Sassar a year ago. I missed it, folks. Is it just basically now EM is back and it's a double-digit return? Is that how if a sea change after, what, 10, 15 years lost in the woods, that EM is back with double-digit return?
Again, this has to be framed from a valuation-based perspective. So EM is back as more of sort of a marketing slogan. We have to say, are these things well valued? Should institutional investors allocate their money to these things? And from a dollar-based perspective, it's not always the case that you should, for example, allocate to local markets EM. When the dollar is cheap, you shouldn't. When the dollar is rich, you should. Now, from other numeraires perspectives, it can be more of an always on allocation, places like sterling or CAD or Aussie, even yen, because the volatility of the cross is much lower than, I'd say, a dollar or a Swiss cross
Right.
relative to EM.